If you're self-employed and earning six figures, the IRS lets you shelter up to $72,000 per year in retirement contributions. That's 3 times what an employee at a normal company can put away. The account is called the Solo 401k. It's been on the books for over 20 years. Most self-employed people either don't know about it or use the wrong account instead. In 10 minutes, I'll show you how the contribution math actually works, why it beats the SEP IRA almost every time, and the December 31st deadline that catches half of new users. The Solo 401k exists for a specific situation. You own a business with no full-time employees other than yourself and maybe a spouse. That structure unlocks contribution limits no other account approaches. You contribute as the employee first. Up to $24,500 in 2026, same as any 401k employee deferral. Pre-tax, Roth, or a combination, your choice. This is the smaller of the 2 buckets, but it's available to anyone with self-employment income, regardless of how much. Then you contribute as the employer. Your business contributes profit sharing on top of your employee deferral. If you operate as an S-corporation, the limit is 25% of your W-2 wages. If you're a sole proprietor, the effective limit is about 20% of your net self-employment income after the deductible half of SE tax. For most six-figure earners, the employer side ends up between $30,000 and $47,000. Combined, those 2 buckets cap at $72,000 in 2026 for anyone under 50. If you're between 50 and 59, or 64 and older, the catch-up adds $8,000, bringing the total to $80,000. If you're between 60 and 63, the enhanced catch-up under Secure 2.0 takes it to $83,250. These are the highest individual retirement contribution limits in the U.S. tax code. If your spouse earns income from the business, they get their own separate limits. 2 spouse households running the same business can effectively shelter $144,000 per year. That's not a typo. That's the structural advantage of being self-employed with retirement planning done correctly. The Solo 401k competes with one main alternative, the SEP IRA. Same ceiling, different mechanics, very different outcomes for high earners. 5 differences that matter. Contribution structure. Solo 401k lets you contribute as both employee and employer. SEP IRA only allows employer contributions. There's no employee deferral component. That single difference is what makes the Solo 401k reach the $72,000 cap at lower income. Income required to max it out. To reach the full $72,000 in a Solo 401k, you need about $238,000 in net self-employment income. Same ceiling in a SEP IRA requires about $360,000. The Solo 401k hits the maximum sooner because the $24,000 employee deferral fills the bucket regardless of income. Interaction with backdoor Roth conversions. This is the silent deal breaker. Last week, we covered the pro rata rule. SEP IRA balances aggregate with your other IRAs and contaminate every backdoor Roth conversion. Solo 401k balances sit completely outside that pool. If you ever plan to do backdoor Roth, the SEP IRA is a trap, and the Solo 401k is the answer. Roth contribution option. Solo 401k plans support Roth employee deferrals at every major provider: Fidelity, Schwab, E-Trade. Secure 2.0 added Roth options for SEP IRAs starting in 2023, but most providers still don't implement them. If you want Roth flexibility, the Solo 401k actually delivers it today. Administrative complexity. This is the SEP IRA's only real advantage. Opening a SEP IRA is just opening an account. No plan document, no annual filing ever. The Solo 401k requires a plan document at setup and Form 5500 EZ filing once your balance crosses $250,000. If you're contributing low amounts and don't care about backdoor Roth or Roth contributions, the SEP IRA's simplicity might be worth it. For everyone else, the Solo 401k is the right choice. Let's run real numbers on a typical six-figure self-employed earner. Start with $200,000 in net self-employment income. That's gross revenue minus business expenses, as reported on Schedule C. This is what most consultants, freelancers, and independent contractors would see on a typical year. First adjustment, deduct half of your self-employment tax. On $200,000 of net income, the SE tax works out to about $23,000 total, and the IRS lets you deduct half of that, roughly $11,500, for the purpose of calculating retirement contributions. Net earnings from self-employment after that deduction, about $188,500. This is the base used for the employer contribution calculation. Employer contribution. As a sole proprietor, the effective rate is 20% of that net earnings number. 20% of $188,500 equals $37,700. That's the profit-sharing piece, entirely deductible from your business income. Employee deferral. On top of the employer contribution, you can defer up to $24,500 as the employee. This is independent of business income. You just need at least that much net income to deduct it. Pre-tax or Roth, your choice on this portion. Combined total, $62,200. That's 31% of your gross self-employment income, sheltered from current year taxes. At a 24% federal bracket, the immediate tax savings come out to about $14,928. That's cash you keep this year, plus tax-deferred compounding on the entire $62,000 for the next 30 years. For a sole proprietor making $200,000, this is the largest single tax move available. Bigger than the mega backdoor Roth, bigger than the HSA, bigger than every other account combined. Six steps. Most are one time. The third step is the hard deadline that catches new users. Step 1. Get an employer identification number from the IRS. Even sole proprietors need one to open a solo 401k. The form is online, takes about 10 minutes, and the EIN is issued immediately at the end. Don't use your social security number. Providers will require an EIN. Step 2. Choose a provider that supports both Roth contributions and after-tax contributions. The major brokerages, Fidelity, Schwab, E-Trade, all offer free solo 401k plans. Avoid platforms that charge percentage-based AUM fees on your balance. If you want true self-directed investing, real estate inside the plan, private notes, alternative assets, there are specialty providers like MySolo 401k or IRA Financial, but expect to pay setup and annual fees in the hundreds. Step 3. The deadline that gets people. Establish your plan by December 31st of the tax year. This means the plan document must legally exist before year-end, signed and on file. You don't need to fund it yet, but the plan itself must exist. Set up the plan in October or November to give yourself runway. Wait until December 31st, and any provider delay kills your contribution window for the entire year. Step 4. Make your employee deferral election by December 31. The actual money doesn't need to be in the account by year-end. You have until your tax filing deadline plus extensions to fund it. But the election must be documented before December 31st. This is what tells the IRS you intended to defer income for the current year. Step 5. Calculate and fund the employer contribution after year-end. You need to know your final net self-employment income to calculate the employer side, which means waiting until your books close. Most sole proprietors fund the employer contribution in February or March before tax day. If you file an extension, you have until October 15th of the following year. Use this flexibility, but don't forget. Step 6. File Form 5500 EZ once your plan balance crosses $250,000 at year-end. This is an annual one-page filing due July 31st of the following year. It's not difficult, but the late penalty is $250 per day. capped at $150,000 per return. Calendar it. The IRS automated system catches missing filings, and the penalty letters are not negotiable. 6 mistakes that cost contribution room or trigger penalties. 1. Hiring a full-time non-spouse employee. The solo 401k is owner-only by definition. The moment you have a W-2 employee who works more than 1,000 hours a year, the plan stops being a solo plan and becomes subject to full non-discrimination testing. Plan ahead. If you might hire, consider a safe harbor 401k structure that handles employees from day one. 2. Forgetting the December 31st plan establishment deadline. This is the single most expensive mistake. You can fund contributions later, but the plan must legally exist by year end. Open the plan in November, even if you don't fund it. Future, you will thank present you. 3. Mixing W-2 401k. Employee deferrals with solo 401k. Employee deferrals. The $24,500 employee deferral limit is per person, not per plan. If you have a W-2 day job where you contribute $20,000, you only have $4,500 of employee deferral room left in your solo 401k. The employer contribution side is unaffected. You still get the full profit-sharing capacity, but the employee bucket is shared. 4. Choosing a SEP IRA instead of a solo 401k without realizing the pro-rata trap. If you ever plan to do backdoor Roth conversions, and most high earners should, the SEP IRA pollutes every conversion. The solo 401k doesn't. Same contribution ceiling, very different downstream consequences. 5. Skipping Form 5500 EZ when your balance crosses $250,000. The penalty is $250 per day from the original due date. The IRS doesn't send a courtesy reminder. Many solo 401k holders discover the requirement only after they've crossed the threshold and missed the first filing. 6. Over-contributing as the employer. The sole prop employer limit is 20% of net self-employment income, not gross revenue, not net before SE tax deduction, not Schedule C, Line 1. The exact calculation is on IRS Publication 560. Excess contributions trigger a 6% annual penalty until corrected. When in doubt, contribute slightly under your calculated max. The marginal contribution isn't worth the penalty risk. The solo 401k is the most powerful tax-advantaged account available to anyone with self-employment income above $100,000. Up to $72,000 sheltered per year, $14,000 in immediate federal tax savings at the 24% bracket, no pro-rata pollution of your other strategies. If you're self-employed and not using one, this week is the time to set it up. Next week, 2026 tax bracket optimization for high earners, the specific moves that matter most before April. Subscribe so you don't miss it.